So for now, it's looking down and out. But since this is all related to what's happening globally, at least a large part of it, we have someone who tracks that space closely. Global macro strategist Arnab Das is now with us on the phone line. Arnab, good to have you back on the program. It's been a while. Thank you for your time. First of all, do you have a view on the trioca of troubles, so as to speak, yields, the dollar index and oil? That's one, if you have a view in terms of where they're headed, whether they're topping off, etc. And second, if they were to stay here or not correct, what's likely to happen to emerging markets, especially India?
Okay, well, thanks for having me. Listen, I think it's a challenging environment because because of the supply reduction by Russia and Saudi Arabia, in particular in OPEC, and that of course has created some tension in the oil market and some expectation that inflation might be higher than otherwise at the same time that the Fed and other central banks have been signaling higher for longer. We have much more resilience in the U.S. economy than people have expected for some time. I think that explains why we're in this kind of tighter environment with a sell-off in yield and in risky assets and in to some degree in emerging markets. I think it's going to be quote unquote okay in the sense that I don't think we're looking at a repeat of what happened after the invasion of Ukraine. It's much less of a shock than it was then. We're much more advanced in the tightening cycle than we were then and during the course of 2022. We're in an environment where we're talking about possibly one more rate hike from the Fed, and we're possibly talking about the Bank of England going on hold for an extended period, the ECB probably also going on hold, although these pressures will add to headline inflation in those regions. Core is really what matters, right? And it tends to be the case that when you have these pressures on inflation, headline inflation through energy prices or commodity prices late in the tightening phase, it tends to be inflationary for headline inflation, but it also tends to be restrictive for consumers and others to spend. So it probably means that we're getting closer to the end of whatever kind of cycle this is, and that it'll eventually be what we are calling a bumpy landing, right? That there are a lot of issues and shocks and polycrises, as they say, going on. But it's not a systemic kind of crisis. It's not a situation where, because the Fed has been tightening so aggressively, that quote unquote something is going to break, right? What's happened is regional banks have broken, but those were interest rate losses, not credit losses. So it wasn't a consequence of the transmission of monetary tightening into a recessionary force. It was a problem in the balance sheets of those banks. And I think that's a good metaphor for where we are. We're going through this adjustment. It's bumpy, but it's not terribly painful, actually. And it's not certainly not a crisis situation. Yes, sorry.
Arnab, sorry to come in over there. I just wanted to ask you this. What you said right now, the banking issues in the US, those were interest rate hiccups or problems, not credit problems. But could the interest rate problem at some point in time start becoming a credit issue as well? And is that perhaps something that no one's kind of anticipated right now? And the reason I ask you this is that you've got yields at 15, 16-year highs. Stock markets, the US market is barely 6% off the peak. India is barely 3.5%, 4% off its peak. So have equity markets not adequately priced in possible risks?
Well, I think that certainly is a risk, and I think it's something we all have to keep in our minds, that this could still go significantly wrong. I would say that it's a tail risk rather than a very significant, very high risk, let alone a central scenario. And the reasoning is this, right? That during the easy period when monetary policy was, when rates were zero and central banks were expanding their balance sheets because we had, quote unquote, low inflation, the reason we had very low policy rates or negative policy rates and negative yields in many cases on many bonds is because the private sector was not gearing up very heavily during that period, right? So we didn't have the kind of ramping up of risk in the financial sector and especially in the real sectors of the economy at the time when policy was easy. That's why it had to be so easy, right? It's because there wasn't that much investment, that much leverage going on. There was some financial leverage for sure, but there wasn't a huge amount of capex going on. That's why we had such low yields. And that's why this tightening phase is likely to be, to unfold very differently than other tightening phases. Actually, the leveraging up took place in the public sector, not in the private sector, because the private sector was, if anything, deleveraging after the global financial crisis, after the Eurozone crisis, and even in emerging markets, right? There was a big credit boom in India and other countries in the aftermath of the global financial crisis. And of course, everybody will remember in India, we had the twin balance sheet problem. That's been substantially worked out now with a period of somewhat lower growth. And so I think, private balance sheets generally are in better condition than in most tightening phases. So that's why I think we'll have some credit losses for sure. That seems quite likely. But whether it's a really serious problem, I think that seems relatively unlikely. Now, of course, if rates have to go a lot higher and stay a lot higher for a lot longer, that risk will rise. But I think that's unlikely because we have been tightening. There is evidence the economies are slowing down in the West and core inflation is falling.
Arnab, thank you very much for joining us this afternoon here on CNBC TV 18. We need to slip into a very short break. We'll come back and talk about the Indian market stocks. Devendra Choksi joins in on the other side.